Do you ever worry about how you will pay for school or what all the loan types you hear mean? Well, then this video is for you. It is going to discuss the various types of loan options available to you when you go to college. There are four main types of loans that you can choose from. These include subsidized, unsubsidized, parent plus, and private loans. All are slightly different, so it is important to research your options. In this video, we will give you a quick overview of each of the types of loans and talk about some things to look for with the loans. That way you can make smart money choices. The first type of loan is subsidized loans. This loan amount is determined by your estimated cost of attendance subtracted from your estimated family contributions. To be eligible for this type of loan, individuals must have a financial need that is determined by filling out your FAFSA. The interest rate on this type of loan is fixed, and you will not have to start to pay back a subsidized loan till after you leave school. So as long as you are at least part-time in school, you will not have to worry about paying back your loan or interest incurring. Then there are unsubsidized loans. Unlike unsubsidized loans, these loans will incur interest while you are in school, but you will not have to start paying back the loan until you leave school or fall below part-time status. The interest rates are fixed for this type of loan, and individuals have the opportunity to borrow more than they would from a subsidized loan. However, you still want to be careful as interest can add up when you are taking out larger loan amounts. To be able to apply for both subsidized and unsubsidized loans, individuals must complete FAFSA, be a U.S. citizen, national, or permanent resident, be enrolled in at least half-time, not have defaulted or owe a refund to any previous aid programs, and maintain satisfactory academic progress, according to the University of Florida. Then there are Parent Plus loans. Like all loans, you want to be careful, but as this one will allow an even larger amount to be borrowed and has higher interest rates, you will want to be conscious of this. Parent Plus loans are loans that a parent or adoptive parent takes out for their student to attend college. The maximum amount an individual can take out is determined by the cost of attendance of the school minus any help you are already receiving. This means if it costs $30,000 to attend school, but you are already receiving $13,000, the maximum you can take out would be $17,000. This loan will start incurring interest when you are in school. The interest on the loan is higher than the previous two loan types. Unlike the previous loans, this loan is in your parents' name, meaning they are responsible for the payments to be received. In order for your parent to take out a Parent Plus loan for you, they must pass a credit check. If you are able to take out the loan, they will have to pay an origination fee. This means they must pay a certain percentage of the loan amount that you are taking out. So if we go back to our example, we see that your parent intends to take out $17,000 and there is an origination fee of about 4%. Then we would have to pay about $680 to take out the loan. Not only must your parent pay the origination fee to take out the loan, they are responsible for paying back the loan as soon as possible. This means while you are in school, payment should be made to start paying back the loan or at least the interest that is incurring on the loan. As this loan has an origination fee, higher interest rates that start from the time of borrowing, and is under your parent's name, you will want to be very careful when using it to borrow money. Remember that you don't have to take out the full amount that they allow you to borrow, just take out what you need. This will help you to not incur as much interest over time. These past three loans require that the student complete FAFSA in order to be eligible for the loans. Then there is the last type of loans this video will cover, which is private loans. These types of loans are coming from an outside source, not the government. Outside sources can include banks, credit unions, state agencies, or the school itself. These types of loans should be a last resort because they are not always fixed rates and may have higher interest rates. Because private loans are not managed by the government, they are all different depending on who is loaning. Also, you cannot get reimbursed from the government as they are from an outside source. Some differences that you can expect to see when looking at private loans are that they will allow you to borrow more money, interest rates are not necessarily fixed, and they may be more expensive than taking out loans that are from the government. As you can see, there are many things to consider when taking out a loan. It is important to weigh out the pros and cons when making a decision because you will have to pay this money back. Try to look at the minimum amount of money you will need rather than taking out the maximum loan amount. Also, make sure to look into the interest rates and when you will have to pay them back. If you are conscious of these things and pick a loan that will work for you, you will be able to make better money decisions. This is going to be the end of this video, but we hope this video helps you know a little more about what you should research when looking into your loan options.